Hey harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be going over the trades I executed for May 6th. I'm going to be talking about my cash secured puts, my covered calls. I'm going to be talking about how I strategically chose the different strike prices for both the CCs and CSPs. Then I'm going to be going over the last 17 trading days and how this has performed. And then we're going to make a determination, is this better than owning high income ETFs? You have pros and cons for both, and we're just going to discuss a little bit in between. And then we're going to go over to Robinhood and then actually talk about executing specific plays for tomorrow, May 7th. So let's get this going. If you are a new viewer to the channel, the whole point of this Robinhood account is for premium generation. That's either daily, weekly, monthly, or yearly. I have other trading accounts that are more long-term based. I had like 401ks, Roth IRAs, HSAs. I also have investment properties. I own my own house. So I'm set in that regard. And the whole point of this is how can I potentially find a mechanism to, I don't like to use retire because retire seems like you don't want to work anymore. It just gives you the freedom that money allows you to have. So that's what this channel is dedicated for, is how could I make an extra income to increase the quality of my life. With that being said, let's go over to my Robinhood and talk about what the account value looks like. Right now, the account value for my trading platform is $90,673.54. Let's go over the spreadsheet and talk about the different options I ran. All right, guys, let's talk about May 6th and the trades I executed for May 6th. The first thing I did was a covered call. And to understand why I chose this specific strike price of the 564, you have to understand what price did I buy my 100 shares of SPY. If you're not familiar with options trading, to run a covered call, you need to own 100 shares of the underlying. Having 100 shares allows you to trade one options contract. I only have 100 shares of SPY. So I ran one options contract. So initially, when I bought my SPY shares, I bought them at the 559.62. So I usually don't like to choose a strike price that is below this number, that 559.62. So for my covered calls, ideally, I like to choose something that is able to appreciate more and capture some of the upside. And I'm willing to sacrifice some of the premium. It really depends on the day. The last couple of days, the premium for my covered calls hasn't been too high. So therefore, I'm thinking maybe tomorrow I might be a little more aggressive with my strike price. But for May 6th, I got $30 from my covered call. I chose a strike price of 564. And then when the SPY was trading this morning, it opened at the 557.86. So I choose a strike price that was about $7 to $6 away. And I thought that was like a pretty good margin because the market looks really stagnant right now to downtrending. So I didn't think they were going to get assigned, and what happened? They were not assigned, but bagged $30, simple. Took me about 2 minutes to run that trade. And then for my SPY, so the way that cash secured puts work for SPY is an investor is going to pay you upfront premium to lock in shares at a specific price. So what this means, usually it's for a downward momentum. And the way it works, investor pays you upfront premium for the shares, but then you have to have collateral to buy those 100 shares of SPY if that strike price is at the money at the end of the trading day. So what does that mean? So for this SPY trade, I needed to have about $55,600 of collateral set aside. That's either cash or margin, so I can execute this trade. But with that being said, I made $70 from that transaction and made $70 from that transaction. The strike price I chose was the 556, and it was about $2 away from that. So I thought I chose a pretty good strike price. And then was the option assigned? No. So in total, today for May 6th, I made $100 of premium. That's a little bit lower than my daily average, but I'm fine with that. As long as I'm making money, that's really all I care about. All right. With the daily options discussed, let's go over to the holistic view of the last 17 trading days. I've been running this since about April 11th. So let's discuss those numbers. Taking a look at the tractor that I have created starting on May 6th, I made that $100 of premium, and the last 17 trading days has netted me about $3,258.53. If we look at the trade win percentage, it's currently at 94.12%. So I'm winning about 94% of my trades. I had 16 winning days, 1 losing day, and then there was 17 total trading days. In an average month, the amount of trading days is somewhere between 20 to 22. I have about 3 more days before I have like a full month of data. We'll see what the numbers look like once that milestone approaches. But for the average premium per day, it's at $191.68. The average weekly premium is about $1,086.18. And for the average monthly premium, I'm about $3,258.53. Once I hit those 20 trading days, then I'll start resetting the numbers and making it a little bit more accurate. You guys know me. I like to come up with averages whenever I'm running these scenarios. So if I were to estimate this exact same setup over the last 17 trading days, in a 1 year period, I would make $39,102.36. If you look at that as a return, that's about 45% if we're comparing it with this $86,312.66. So if you're asking me, 45% is quite significant compared to the average return of the S&P 500, which ranges somewhere between 8 and 12%. There's years where it fluctuates, but on average, that's what the number is. Going over the weekly tracker, I'm not going to go over the last 3 weeks. You guys can see first week I've done this project, $1,688.11. Week 2, $848.92. Week 3, major mess up, lost $740, but it could have been worse, but I've won a few trades in that week, so the damage wasn't absolutely terrible. And then week 4, I made $1,188.50. And then currently we are week 5, and we are at $273 after 2 trading days. For the month of April, I made $2,289.53. For the month of May, I've already made $969. And the yearly tracker is going to be what we already talked about. Cool. Now with all of these data points annotated, I definitely think there is a case that options should be a part of everyone's strategy. They're not relatively difficult to run. It's finding whatever strategy is right for you. Some people, they're going to want to capture more appreciation than premium because they're trying to invest long-term, but they're trying to squeeze out a little bit of premium in addition to that appreciation. Some people like me, I'm more like a hybrid approach. I want to capture some upside, but really I want to just maximize premium as much as possible. And it just depends on the day. When I have more contracts of SPY under my belt, I'd be choosing like a different spreads. Like I'd be choosing different strike prices for the different contracts. So we'll see how it plays out. But ideally, I still need to get there, and that's quite some time away. But the high income ETFs, they do have a tax advantage aspect where it's return of capital until you get your cost basis back. So it's like really depends on what your strategy is. But I think a hybrid approach is the best option. Let's go over to Robinhood and discuss the options trades I'm going to be running for May 7th. All right, guys, let's go to my favorite button of all time, the money printer button, which is the trade SPY options. Every time you click it, you make money. Let's do it. For anyone that is a new investor, don't ever press this buy button. That's when you have to pay an upfront premium to run specific options. Yes, there's more upside with making more money, but there's also a significantly more amount of downside. So unless you are very familiar with the market, I just recommend doing the covered calls and cash secured puts. And to run those covered calls is sell call. For cash secured put, it's sell put. Cool. So let's go over my covered calls I plan on running for May 7th. Usually I like to run dailies for my SPY shares. I ran a cash secured put in a video yesterday on Monday, and those are week longs. But for SPY, I prefer running the dailies over weeklies because I'm able to change. I'm able to adjust my strategy with the movements of the market. So currently, SPY is trading at that 561.69. Probably going to choose something about $5 away from that strike price. So this 566 looks good. Maybe this 567. If I can lock it in for this 567 for $47, that'd be fantastic. So I'd probably choose something like that. And kind of reiterating the point of covered calls. To run a covered call, you need 100 shares of SPY. 100 shares is one contract. And in this column, this bid price, this is basically telling you how much it would cost per contract. So for my 100 shares of SPY, I'd get $47. This doesn't seem like a lot of money, but this is only for one day. You multiply this by 5, that's $250, or a little bit less, about $245. But that's still better. That's still a better mechanism to me than having high income ETFs. So I'd probably choose something at this $47 mark. And going back to the options, the way covered calls work is investors are going to pay you an upfront premium so that if your SPY shares appreciate to a certain point, you're going to have to sell your 100 shares to that investor that paid you that premium. So that's how that works. So say, for example, let's lock in this 567. We hit continue. We buy it, the one contract at the 47 cents, but it's $47. We review the order. And basically it's saying you're agreeing to sell the 100 shares that you own in exchange for that if the strike price gets to 567 before May 7th. So the way this works is there's a couple scenarios that can play out. SPY is trading at the 561.90. It gets nowhere near the strike price. The investor is going to pay you that upfront premium, and then you get to keep your 100 shares of SPY and you get to rinse and repeat. So say, for example, into 566 or 565, but we had that 567 strike price because the strike price wasn't at or above this 567 or 568. You basically keep your shares. They were not assigned. You keep that premium and then you rinse and repeat. However, the second scenario is, say the S&P 500 blows past this strike price at the 567. It can be 567.01, and then you'd get your shares assigned, but you did get the premium. And then on top of that, if the SPY was trading at this 561.90, you get all the appreciation from 561. So from this point all the way up until this 567. So you'd make like what, almost $600, almost $500 of appreciation plus this $47 of premium. So that's how covered calls work. And I'm probably going to choose this 567 or maybe this 566. Or because I'm thinking the market might go down, I might choose something a little more aggressive, closer to that strike price. Might choose this 564, 563. Depends on the market in the morning. We can talk about what we're going to do the night before, but end of the day, the pre-market and then how the market opens in the first 15 minutes really dictates how I actually execute these options. So now let's go to sell put. So sell put is running a cash secured put. So let's talk about how this works. Right now, SPY trading at the 561.70. And the way cash secured put works is investors are going to pay you that upfront premium so that they can offload their shares at a specific price. So say, for example, yep, SPY is trading at that 561.70. We choose something, maybe this, 553 strike price. Let's highlight it and then make a scenario out of it. So say the investor pays us this $111 so that we can lock in purchasing his shares or their shares at the 553. If that share price is never reached, I basically keep the premium, get to rinse and repeat, and just use margin or some of my cash as collateral to make this extra $111. But say that the SPY blows below this 553, what happens is I still get that upfront premium. That's always going to be upfront, but then I'm going to have to lock in the shares at this 553. And the one downside of running cash secured puts is if the market is really red and blows way below this 553 mark, you can potentially be losing out on money because you locked in shares that are at a higher price where the market is trading at. So say, we have this 553, but then the market is now trading at 546. So then running covered call strategy against options that are, $5 away from the money, you're not going to be making as much premium. And then you might be left with holding on to shares until they recover their share price. So they're just kind of some scenarios that might happen. But yeah, if tomorrow happens and the strike price at 553 can net me about $111, I'm probably going to choose this. Like I said, pre-market's going to change it. How the market opens the first 15 minutes is also going to play a factor as to how I run my options. I usually like to choose something $5 to $10 away, but if the market is trending downwards, I might be more aggressive with my my covered calls. And then in reverse, if the market is trending bullish, I'll probably be more aggressive with my cash secured puts so I can lock in a little bit more premium. So that's kind of how I trade and I operate. Yeah, guys, let me know what you think in the comment section. Quick video. Want to do an overview of May 6th and then what we plan on doing for May 7th. That's the video, Matt out, and I will see you at the next one. Hope your portfolios are all doing well. And